So they debit treasuries and they credit due to Banco Popular de Hialeah or whatever, you know? Whoever they bought it from. So the way we've printed money is by essentially buying treasuries from ourselves.
Isn't that like some kind of
Ponzi scheme or something?
Circular firing squad.
Hey, man.
And then we sold it to China.
Well, China's holding about, so of the 19 trillion, China holds about 2 trillion of it, but our Federal Reserve holds $3 trillion worth of treasuries. So even our central bank is financing our deficit now. And ultimately, I mean, you owe this to the banks. That's a real liability.
That is not good. I mean, it doesn't sound good.
Does not sound good to me either.
One day we'll find out what it all actually means.
I think we should go back to the old step.
And it will happen in our lifetime.
Okay, so, now to answer your question, so in addition to this regulation, in addition to the capital requirements, there are reserve requirements that,
That you just said the banks really don't have.
well,
I mean, in theory.
there are reserve requirements that, and that's another way to control monetary policy, is the central bank requires the banks to put a certain amount of money in deposit at the central bank. So it's taking money out of their balance sheet or putting money back into their balance sheet in order to lend or not. So when the economy is doing too well and people are afraid there's inflation, the central bank will require a higher reserve requirement to take money out of the bank's balance sheets, liquidity out of the bank's balance sheet, so they can't put as much credit out on the street to cool things off. And when things are tough, they'll lower the reserve requirements so that there's more liquidity. I don't remember the number now. I told you 10%. I don't remember what the number is.
And that process of taking and putting in and taking out is quantitative easing?
No, quantitative easing is buying treasuries. Reserve requirements so there's capital requirements. So how do you control banks? By requiring that there be more or less capital, by restricting the amount of capital that they can deploy to a particular client, by regulating what they loan and what they invest in, but also by controlling how much they have available to loan or not, by making them put money in deposit at the central bank, or not. Now, there's a couple of other, so in addition to raising capital and borrowing from their customers, banks can issue debt, right? They can issue debt. And they can also borrow from the central bank. When you borrow from the central bank, you borrow what's called the discount window. So when we talk about the Federal Reserve's base interest rate, we'll talk about this probably at this point in the next class, the rate that the Federal Reserve charges its member banks is the discount rate. You go to the discount window. You need liquidity. You need liquidity to meet your reserve requirements. You can't sell any, you can't do any repos. You need liquidity. You got to go to the discount window and borrow money from the Fed. You borrow money. Now that's the discount rates, you know, what they're talking about raising. Now there's a target. There's a Fed funds rate that they target, but a Fed funds rate, we'll define those later, is what banks loan to one another at, okay? So that, the Fed targets that, but that's a market set rate. What the Fed really sets is the discount rate. Now, how many banks borrow in the discount window?
No.
How many banks? Or what, which bank?
About 5.
Which banks?
About 5.
Banks don't borrow at the discount window, because if they do, like, they'll get intervened before they have to borrow. I shouldn't say that. You know,
So who buys in discount window?
Who borrows? It's there available, but people don't really avail themselves of it, because what happens is, it's a stigma. If a bank has to go to the discount window, it means that they're in a bad way. And typically the way the banks meet their reserve requirements daily is they will sell treasuries to one another under overnight agreements. repo, repurchase agreements, so they'll sell treasuries to get liquidity to put at the bank, at the central bank, and they do that every day. But if you can't do that, and you gotta go to the discount window, you got a problem here. And so people stay away from, you heard the term counterparty. You try to stay away from that party. You don't wanna be counter to that party in a transaction. Did I answer your question?
Yes.
And more than you ever wanted to know?
I'll make sure not to ask any more questions.
Well, this was all material we would cover directly or indirectly. If we understand how financial institutions work, right? That's why I try to, ultimately bring it back to real estate one way or another. If we gotta borrow $60 million, we gotta know what bank can loan it to us, right? I mean, can we go to the first bank to Sunrise?
No.
How do you find that information out?
It's all public.
Yeah.
It's all public. It's all public.
What would you look for?
Where?
What's the what?
Where? Google?
The Federal Reserve would have information. There's a service out there called Zacks, which tracks banks. You can ask your lender, hey, what's your lending limit? What's the bank's capital?
What's the lending limit for Ocean Bank?
I've lost track of that. Ocean's probably a $2 to $3 trillion bank now, I would imagine. I believe the actual lending limit today is 15%, I think, to a customer. So theoretically, they could probably loan, $400 million to, $300–400 million to a customer.
BB&T is the same?
They'll probably have a house limit of $50–60 million. And they probably wouldn't underwrite a loan more than 100. That would be my sense. No, BB&T is a regional bank, which would have a significantly higher capital base. So the banks down here, I'm out of sync with some of this. Bank United, Mercantile, City National.
Those are local.
Yeah, local
Okay.
banks. Ocean Bank. And then you get smaller banks below that. Then you start getting like Gibraltar. So Gibraltar will do probably like more residential, or a small home developer, a guy who's gonna build 3 houses. So you gotta find the right bank, okay? You gotta find the right bank.
Professor,
Yes, sir.
let's say you walk into a bank and you wanted to borrow $100 million.
Me.
Yeah, and let's say the bank.
You coming with me?
Yes. Let's
It's
say
easy.
the bank is not in a position to do it. Could the bank say, okay, we'll make this loan, but we need to coordinate with other banks?
Right, so what'll happen is a bank cannot initiate a loan that it cannot underwrite.
Perfect.
So, right, so if the loan is above their lending limit, they cannot initiate that loan. Now, they can initiate the loan and then sell off bits and pieces of it. That's one way to do it. Or there can be a syndication from the beginning. Under a syndication, you've got multiple banks loaning the money. Slight difference, and again, I'm not an attorney, but there's a slight difference between a bank selling participations in loan to a syndicated deal. In a syndicated deal, you have multiple underwriters. You may have a lead bank that operates as the syndicator. So you may go to that bank and they'll say, listen, that typically will not happen with small banks. But B of A will have a syndicating department, and they'll say, hey, yeah, we can't underwrite a $1 billion loan, but we'll sell this. We'll syndicate it. There'll be documents that'll be published out there that everybody will be comfortable with, and they'll manage the deal for you for a fee. And they may take a piece of it or not. Okay? We covered all these pages. All these pages were the answers to your question, okay?
I enjoyed it. I know, I don't want to get into like chapter 10 yet.
It's painful, isn't it? This is all.
Are you gonna be sharing those slides?
Yes, Ben. I already told you.
End of the
I already told you I would.
At the end of the semester?
Yeah. He'll do a slide dump.
If you
on
had
us.
come on time, though, what did I say early? I would send this one?
And
After the next
Claire.
year.
At the end of Claire.
Yeah, or like tomorrow or Monday if I
We
could,
haven't sent any yet, right?
because we haven't finished. I'm about to
He's gonna
finish.
do a
first.
wiki dump on us.
Just to be sure.
Listen. I hope WikiLeaks doesn't get a hold of this. Okay. What do insurance companies do?
They insure people.
They take premiums
And provide insurance.
for customers and they lend it out. They cover their obligations and they lend the rest of it.
They provide a benefit for a certain,
Premium.
yeah,
Charge.
They assume certain risks in exchange for, you know, a premium, right? So, so instead of taking deposits to pay you back, they're taking deposits, so to speak,
In the premium.
in the way of premiums, and
They invested.
assuming certain potential or contingent liabilities for you, okay? Now, there are a lot of different insurance companies, okay, out there, all right? The process by which they do this, it's called underwriting. So they will evaluate the risks and then assign a risk premium to that. You know, in a way, they're no different than a government is, right? If their assessment on an annual basis of the cost of those risks compared to what the premiums is charging is off, what do? They either borrow money, right? Or they do what? They increase premiums the next year, right? So it's kind of like a tax, right, in that sense. Now, insurance companies originated as what? They were all mutual companies. So people got together, Mutual of New York, right, you know, Prudential, Met. Northwestern is still, Northwestern Life Insurance Company today is still a mutually owned company. Mass Mutual, they're still member or insured owned. Florida Blue Cross and Blue Shield is owned by its members.
United.
No, United is a stock company now. It's publicly traded, but, so because there was a mutual sort of assumption of risks, we're all in this together, right? We're all in this together, and so a company was created where we all sort of kicked in a certain amount for, you know, it's kind of been formalized, but the process of this is underwriting. They can also mitigate their risk by reinsuring. So there are companies out there that will assume an underwriter's risk or an insurance company's risk in exchange for a premium. So there are, you know, reinsurance companies.
With Lloyd line.
Well, Lloyd's is an exchange in which its members can either underwrite, and there are a significant number of guys there that will reinsure. Okay?
Are there any publicly traded reinsurance companies?
Yeah. There are several that are based in, for whatever reason, I guess the tax laws are advantageous in Bermuda. The two that come to mind right now, there's one called ACE. I don't know all this stuff, junk. This is like useless information.
Trivia.
No, it's not Maiden.
Marie.
Meredith? I don't know.
It'll come to me in a second, okay? It'll come. Now, there are also insurance companies that are known that have reinsurance units. AIG would have a reinsurance unit. Swiss Life would have a reinsurance unit. Okay, so within companies there are reinsurance divisions as well, but then there are also companies that are just reinsurers. Okay. This thing's gonna stay in.
So
Yes.
is it just like basically where you have like a bundle of insurance companies that work under each other basically?
Come again?
Reinsurers, they basically have multiple insurance companies at different levels. Is that what it is?
No, so it's a company, so I'm Ace, and I'm in Bermuda, and I'm in the business of just, quote, reinsuring. So my customers, right, my customers are insurance companies that I am reinsuring. So they assume a risk, of $100 million of business interruption from whatever customer, but they're not comfortable with that. So they want to mitigate their risk. So they'll pay me a premium in order to assume all or part of that risk. Kind of like syndication or selling bits of a loan, they're passing the buck to somebody else.
Citizens is what type of insurance?
Well, so so it's a state-sponsored insurance company, okay? It's an entity that was created by the state of Florida. It's in the realm of a mutually owned, right, or for a mutual benefit.
It's usually owned by whom? By the taxpayer?
By the citizens of the state of Florida, okay? For the benefit of the citizens of the state of Florida. So it is the insurer of last resort if you cannot obtain insurance in the private markets.
Now, in Florida, the majority of the insurers, the insurance companies, do not do business because they think that the risk is too high and the premiums are too low. If they were actually going to insure the property, especially coastal property, the premiums will be very high, which will reduce construction in those areas and the value of the property. And then comes Citizens and artificially lowers that premium. It keeps the boom going. But the truth is that if the insurance premiums will be at the right market level, then there wouldn't be that much construction.
Well,
Does that make sense?
Well, listen, it's a perspective. It's a perspective, and it may be right. Anytime, I always make a, when I'm here from the government and I'm here to help. Anytime there's a government-sponsored entity, I get concerned. And so, one, as a taxpayer, let me write something else
We're
here.
all liable, basically.
Okay, hold
I
on.
mean, it's distortion. It's a distortion in the market.
Well, I'm not going to refute that, but what I am going to say is it's a response to a public outcry. I want to change it. This is something else I saw in the news this morning. So, in Chile, you can say, why is he telling me this stuff? In Chile, 30 years ago, they privatized the Social Security system. And worldwide, it's been lauded as the right thing to do, okay? Pension funds people were statutorily required to put away 10% of their money. There were certain authorized companies that were allowed to invest in it. It's a relatively small country. And so they made a lot of investments overseas, and that all has seemed to work wonderfully. What's happening now is that you're starting to have people retire that have been in the system their whole working lives. And now there were huge manifestations in Chile yesterday, in Santiago. Why? Because people are saying the pensions are inadequate. Now, I don't know what the truth to all of this is. So people want to make it public again. And you've got a populist, socialist-inspired government in place now. So I know that in a few months, they will get rid of private pensions and there'll be a Social Security system again, okay? The reason they privatized them in the first place is the Social Security system was insolvent there.
Right.
Now, by the way, what I read today was that the problem is people didn't say the statutorily required amount, so people didn't say what they were supposed to, now to have a pension. But people are saying the government needs to provide for us.
Right.
The government needs to provide for us. And enough people get out on the street with an uproar, then they're going to have this kind of stuff. Now, in this country, there was enough public outcry and there was sufficient lack of interest that rising waters are covered by a federally sponsored program. The flood program in this country is federally underwritten and sponsored. And so at the end of the day, we pay a premium, but there's some entity somewhere in the government, right? There are private companies that originate the policies and manage the policies, but at the end of the day, the backstop is the federal government. Why? Because people all over the Midwest especially were subject to these, you know, devastating floods, okay? And so, there was enough outcry that the government said, hey,
We're here to help.
we need to create a program to protect these people, to mutually protect these people. And because the private sector isn't doing this regulation, the positive spin on this is, in the absence of the free market is not efficient like Adam Smith said. Okay, it's not always going to do the right thing, so we as the government need to help our people.
Right.
Okay? And so that was created. Now, there's been a push for a national citizens type. You know, there's enough coastal communities throughout the country that are affected by windstorms that there's been advocates for it. It's never gotten enough. There's not enough people, right, that have raised a stink about it. And so the state had to do it. Here's the issue. I don't know if citizens is right or wrong, but, you know, 10, 12 years ago, or whenever it started, you know, or 15 years ago, or whatever, it got legislated in because the people we voted for decided that it was important for us, because their constituents theoretically thought it was important for us, right? And it exists. You don't need to avail yourself of it.
No, but there are no others.
And so, yes, there's a macro argument that you're saying, well, it's supporting the construction in the coastal areas, but as a resident in a coastal area, and by the way, I don't use Citizens. I haven't used Citizens. I've been able to get private insurance for at least 10 years now through somebody at Lloyd's, through a broker that then uses one of the members of Lloyd's. But the problem is, as a citizen, you'd also say, hey, look, I don't want to assume this risk, and there's no private provider, and there's a state provider. Then I can decide whether the costs that they charge. The other issue really is to say, is that a solvent company? Because the problem is, how much risk are they underwriting, and what reserves do they have available to cover it?
You mean citizens?
Yeah. And the problem is, if they are faced with a catastrophic event,
It's gonna go under.
well, it's not going to go under.
Right, because
Reinsurance.
we are it,
We're going to pay.
right?
We'll just pay higher
Well,
premiums.
well,
No, we'll just pay higher premiums because they'll charge them to us, or they'll tax us.
Right. Well, the thing is that, a lot of what happens with the flood insurance is that we are, even the risk of very rich people, you know, is being subsidized.
The 1%.
I don't
Those
know,
dreaded
I don't know if it's
1%.
or not. I'm saying that people build, you know, properties that are at more risk, pay, you know, people that can afford it.
Listen, there are severe arguments out there. For example, The Economist, talking about whether you agree with it or not, The Economist for many years, for instance, has advocated that governments should not have insurance funds to guarantee bank deposits. FDIC in this country or other schemes in other countries. In this country today, no depositor in a federally insured bank has ever lost a penny. I should say ever, at least since the FDIC was created. Now, the FDIC, last time I checked, has $60 billion, and they're insuring something like $4 trillion worth of deposits. I'm not sure that's adequate. Okay? But again, what's going to happen? It's a federally sponsored entity. Oh, the bank goes under, no problem. We'll just print more money. We're from the government. We're here to help, right?
To answer your question, it doesn't make sense. None of it makes sense.
Can we move to asset management?
Go ahead and just buy Ron Paul's book and read
We
it.
are too deep into
It's ridiculous.
How do you get a loan, or how do you approach an insurance company for a development project? Or when do you know when to approach a bank or when to approach an insurance company?
Well, before we answer that question,
An insurance company's not gonna fund a development project, they'll buy.
before we get to that question, we need, and before we jump to asset management, because in life, I'd rather that we learn everything so we can answer that question than that we jump to asset management firms, because insurance companies are huge providers of capital to the real estate industry. So if we don't understand how insurance companies work, we don't know who we can approach or why. So there are, I'm going to say broadly, two different types of insurance companies. One is life, right? And the other one is
Property.
casualty.
Casualty, yeah.
So life companies tend to also do health insurance, okay, tend to, right? Casualty are insuring against what?
Property.
Property, right?
Equipment, right?
Okay, now, these tend to be very long-term contracts. Life insurance contracts are very long contracts. What do they collect a premium today for a death when?
20, 30 years from now.
30, 40 years.
Or
From
tomorrow.
Well, it could be tomorrow, but their business is assuming it's not
50, 60
tomorrow,
years.
right? And so
Life
they
of
have to project. They get all this money now, they got to invest it to meet needs over time. Casualty insure things like windstorms, car accidents. They need to have money when? Now, okay? And so what happens is, these guys are huge providers of capital to the real estate industry, and a large component of their balance sheets are investments in real estate, either directly in real estate or debt to real estate. So they will play both the debt and the equity component of real estate, okay? And they'll do the equity component directly or through joint ventures with local developers, okay? They also tend to, jumping ahead, they also tend to manage a lot of retirement and pension money, because they've got the expertise, they've got the team. So Prudential not only invests in real estate for their need, they're a fiduciary through the real estate funds that they manage, where they're managing pension and retirement money, okay? So these are the guys you would go to. You're going to go to who you go to in a second. Now, these guys, they tend to lose over 100% of their premiums on an annual basis. So you say, how do they stay in business?
No money.
No, that would be a Ponzi scheme.
It is a Ponzi scheme.
No, short-term investments. They're trading, they're traders. These guys are in the stock markets. These guys, it's all short-term money, and they make their money. So I think the number I remember was something like,
You gotta be very good then.
yeah. No, but again, highly regulated, okay? So these guys are not really real estate guys, okay? These are the guys we gotta go to. Now, your question specifically on ELO was what?
How do you approach it? How do you approach, and at what point in the development process do you approach them like,
So
Jason said?
Well, so historically, if this is their view, what would they be? They would be likely buyers of an asset, they would be likely joint venture partners in the equity, or they would be likely providers of long-term or permanent financing. Typically, long-term or permanent financing is only available when? Talked about the things we talked about earlier. Certainty of cash flow is one of them. So you need to have stabilization, okay? And so historically, life companies were not providers of capital for construction. That's changed a little bit. You're starting to see some construction financing. The easiest way that I would tell you to approach it, unless you've got a direct relationship through, again, know who, you've worked at a developer, you've met people, you've gone to conferences, you know people from your class. The easiest way to do is go through an intermediary, go through a formal intermediary, go to an HFF, go to a CBRE Capital Markets, go to Jones Lang, go to an E-Still, go to large institutional intermediaries, or go to a reputable mortgage banker okay? And we've got a former student working at one called, he didn't go to the meeting the other day, Ugo is working at, I forget what they're called, but they're, you know, sort of national mortgage banking business.
What is an FFF?
HFF, Holiday Finoglio Fowler, publicly traded.
Wow, the mouthful.
It's a publicly traded intermediary, okay? He's still owned by Wells Fargo, but that's the other large one, okay? Now, there's another player that's important. So a different way to categorize these is insurance companies can be multi-line or monoline. Multi-line is what?
Multiple different types
They,
of.
they underwrite multiple lines of business. So a life company may also do health. A casualty company may do auto, motorcycles, boats, okay? Things like that. They may do business, they may do residential. A monoline company would do what?
One.
Okay, well, it's not only single, but in this realm, it specifically deals with a company. When we talk about monoline insurers, we're talking about companies that specialize in one unique line of insurance, which is guaranteeing municipal bond debt, so municipal debt, and related to the real estate industry, what? Securitized debt. So when we get to the presentations that we're going to have on securitization, when we get to the last classes, and we talk about how do we enhance securitized debt so that it's attractive, that there's insurance available to protect against credit default, okay? So that's what these companies do. Now, what happened in 2008 was there was way too many of this underwritten by a bunch of companies that were fly-by-nights, and their insurance was essentially worthless. That's what government starts stepping in, is to protect the integrity of the financial system, was so that these things would not all ultimately collapse and take along with it all the major institutions in this country. I think that's all I want to talk about with insurance companies. There's a whole bunch more we can talk about, but I'm not going to talk about it. Finance companies. I jumped ahead. Finance companies are, what's a finance company? What's a finance company? Hello, what's a finance company? There's a chapter on it, part of a chapter. So, you guys ever heard of GMAC? It used to be called GMAC. What's called Ally Bank now? Never heard of that?
General
Yeah.
Motors.
General Motors Acceptance Corporation. Has anybody ever heard of Ford Credit?
By me?
No. Has anybody ever heard of Chrysler Credit? Okay, so, has anybody ever heard of?
Chase.
No, Chase was a bank. Has anybody ever heard of GE Capital?
Yes.
Yeah.
Okay, so, finance companies were a type of business that provided capital to support industrial or manufacturing activities. We tended to see it, so companies like Caterpillar, companies like Deere, to this day still have a finance division. Ford Credit still exists. Chrysler Credit per se doesn't. It was sold to one of these private equity funds, and it all sort of blew up or whatever, but Ford Credit still exists. GMAC exists as Ally, okay? And Cerberus is who they were sold to. But anyway, what they do is they issue commercial paper. They issue short-term debt at lower rates and loan money on equipment that they produce, or their affiliates or their parents produce at a higher rate. So they make a spread, and they say, well, does that have anything to do with real estate? And the answer is directly no, but GE Capital started out as a company doing that and became a huge player in the real estate realm. I mean, at one point, these people were controlling 40, $50 billion of real estate that they owned. Plus, they were huge providers of MSRED, long-term financing. They were joint venture partners, okay? Huge real estate operations. And GMAC as well. GMAC had a company called ResCap, Residential Capital, which was a huge player in particularly in like subprime mortgages. And part of GMAC going down and dragging General Motors down with it was its involvement in residential real estate. So we don't really see that much activity from these finance companies in real estate today, but they did at one point have an impact. Asset management firms. Asset management firms, essentially, oh, before I forget, I was gonna mention,
So who invests in finance companies like, for example,
no,
GE Capital?
people don't invest, they are owned by typically industrial businesses
Who
that
do they lend money to?
typically they're customers.
Who are their customers?
Buy your
Well, like if
cars.
you wanna buy an aircraft engine from GE, they'll finance it for you.
Ah, okay.
If you
Or
wanna
if you
buy a
wanna
car
buy-
from Ford, they'll
Or
finance it for you.
Ah, okay.
That's what
And
they
they
do.
sell the paper.
in
Well, they don't sell the
Central America,
paper,
buying
they sell
equipment,
commercial
They'll buy
paper.
directly from Caterpillar.
So they do what's
finance.
called, they typically ride the yield curve, and I don't wanna jump to part of the debt presentation, but one of the theories that exists in regards to interest, it's called the liquidity preference theory, tends to say the shorter the maturity, the lower the interest rate, right?
Right.
Why? Because
That's risk.
time brings uncertainty, okay? So all these companies, the way they finance themselves is presumably they'll have pristine balance sheets. They issue what's called commercial paper. What is commercial paper?
Commercial loans.
So they're financial instruments, so they're short-term IOUs issued by companies of high credit that have no regulatory filings associated with them, so they don't trade publicly. This is all institutional in nature. They are under 270 days. They are under 270 days of maturity, right? So Ford Credit will issue all these commercial paper. We'll issue all this commercial paper, 270, for less than 270 days. At what kind of interest rate today? Like 0.15%, something that's like very high credit, very little, very low rate. What do they turn around? So they ride the yield curve. They borrow here. What do they lend? How much does a car loan cost?
3%.
I don't have bought a car lately.
Yeah,
3%,
Plus-
4%,
3, 4, right?
1.9%, who knows?
So they borrow at 0.15 and sell at 390. Right, over a long term. Now what happens when the paper's due?
reissue.
You reissue it again. They gotta pay you, and then they borrow from somebody else to pay you off. Or you yourself you buy their new paper and then they pay you back.
Now, that 270 days is a government regulation?
No.
Yeah, what happens is if you go beyond 270 on the maturity, on this type paper, then you have to register as security, and that's a whole other process in another class.
So they just reissue it and avoid that?
Yeah, or they'll issue more, so they can loan more, okay? And so, but you got your 400 basis point spread or something like that a lender needs to make, 3 to 4% spread, right? And you're happy. Now, what happens is when your yield curve starts sort of going like this, you start running into problems, and if it goes like this, you really got problems, right?
Which you said we're in a flat yield curve currently,
I didn't say that yet. Did I say that?
last class.
The last class we took? Yeah, I think we've had a flattening, we'll do that later in the class, but yeah, I mean, so that's,
Well, we'll one of the articles you sent yesterday had to do with like tips and with interest rates and inflation, wouldn't that affect the yield curves?
Embedded in inflation, embedded in interest rates, you've got an inflation component, and so, the answer is yes, inflation impacts interest rates, of course. Tips are, we'll leave that for later in the lecture, okay? And in fact, you can do something that's called the term structure of interest rates, in which you can derive that yield curve using tips, okay? So you use the tips to kind of extract the inflation component and do it on what is an inflation impacted scenario. Asset management firms are governed by a variety of different regulations. So last thing I was going to mention on insurance, there's something called cat bonds out there, which insurance companies use, catastrophe bonds. That's another way that they finance themselves. So insurance companies can reinsure, or they can pass on to investors. It's a relatively new trend, the risks that they underwrite or that they assume. So they'll sell a bond that'll pay a coupon, and repayment will be predicated upon whether there's an occurrence of a particular catastrophe or not. So basically, as an investor in a bond, you're really underwriting risk. You're almost assuming the risk that the insurance company would assume.
Is that a high coupon then that they're paying out?
Are they what?
Are they paying out a high coupon on that?
Relatively, but it's all relative, you know, I mean, people are starved for yield. So these things have been mixed, but there's been a few of these that have been, you know, issued. Because again, you can predict or you can model the frequency of.
That's like gambling, pure.
Well, it's risky. Asset management firms take funds or manage funds from investors and help manage it, right? So they'll help them allocate it. We'll spend a lot of time on this. They'll help them allocate it. So they could be investment banks, hedge funds, mutual funds, ETFs. So they're intermediaries that take investors' money and help them invest it, okay? They are governed by 3 or 4 major pieces of regulation. You've got the Securities Act of 1933, got the Securities Act of 1934. So this basically deals with initial issuances and initial reporting to investors. This is subsequent reporting, so after this has the creation of the SEC and the regulatory body and all that. There's the Investment Company Act of 1940 and the Registered Investment Advisor Act of 1940. So, you know, if you're going to work at an asset management firm, if you're going to provide investment advice, if you're going to manage people's money, you need to conform with this, okay? With the investment, so all these like series this license and series that license, you need ultimately come back from making sure that the guy you're dealing with is who he purports to be, okay?
If you're doing a private JV for a real estate deal, you don't need to go somewhere all that. Even though you're kind of managing assets.
Hold on, I want to answer that question. Directly when you're doing a joint venture, a partnership between 2 partners or 3 partners, or you know, limited number of partners, the answer is no. There's typically no regulation related because there's no security, there's no financial instrument that's going to trade. However, in real estate, when you're raising funds, one of the things that I brought that I didn't get to was this whole crowdfunding thing. I know Dr. Forgey's big on that. And there was an interesting article, it's a company called Arbor Realty, which is now kind of getting into that space. But if you're raising funds, then you need to be very careful, because if you're soliciting funds for investment from the general public, then you need to conform not only to federal law, but there's state law related to that as well. And so if you're going to, you know, do a general partnership or a limited partnership or raise a fund for real estate, then in fact, you either need to conform and register the securities, or you can only then target, there are exempt individuals, we'll spend more time on that later on, but there are individuals that are deemed to be qualified investors, and because of the, well, there's different guidelines, there's current income guidelines and net worth guidelines, but because of their substance and their presumed investment savvy, they can deem to be qualified investors and acknowledge that, understand the risk and understand that you're working outside the purview of what would be required under a public registration. So you're not going to have the same level of access to information or reporting or regulation. And you can exempt yourself from that.
Okay, so for example, so if you're doing a development deal that is, say, $10 million and the bank requires 40% equity, so you go out and you talk to 10 people to come up with those $4 million, they need to meet some kind of requirement in order for you to be...
Well, I mean, you're treading a gray line there. If you go to one guy and he's your partner, I think you have no issue. If you're trying to find 10 guys and you're soliciting, you're creating material, you're sending it to people you don't know.
Isn't that what
you're
the equity
making-
book is? What they call the equity book? It's like a pro forma portfolio and you
Well,
go into
so-
talk to people?
And again, and again, well, but hold on, we're going back to, if you are soliciting funds from the general public,
You need a license.
you need to conform to these laws. So if you put a deal book together and you're gonna talk to certain capital sources and they are deemed to be qualified investors, and you made all of the disclaimers required and advance warning to let them know and let them qualify themselves with you as qualified investors, and the answer is you're okay, but there's still language you need to let them know that this is a solicitation. And there's risks associated with that investment, there's a whole preamble associated with that.
What class teaches you that here? Law?
I don't know if he deals with that in that class or not. I mean, we're talking about that here.
Yeah, very broadly.
Well, we're talking broadly, we'll go a little bit more in depth into what public registration involves and as the book goes on. But this is, I mean, at the end of the day, if what you're going to be doing is soliciting equity, you're basically soliciting capital from the general public.
That's what I thought developers did a lot.
No.
You got a
My
project,
personal,
you got a project, you need equity.
my personal
requirements.
experience is that yes, is that there's a lot of institutional equity out there, a lot of institutional capital in the way of pension funds, life insurance companies, that you can talk to and can provide what you need, or will provide what you need, but that's not a general solicitation to the public.
Okay. Now, if you meet with people, face to face,
You're,
a
you're,
friend of a
you're,
friend,
I,
is
where
that-
you're,
is that-
listen, where you're going,
Is that general solicitation?
you sound like a life insurance guy with like a carbon, you know, like the bad guy, going door to door asking for money.
Elon Musk.
Well, no, that's all publicly traded. You're starting to tread on this realm. From everything you've told me, you're less institutional qualified investor, and you're much more here.
And there's a reason you can't
Now, there's this new, the Jobs Act last year allowed you to raise X amount of money up to a certain amount without, violating, certain laws. There's these crowdfunding things. I'll talk about crowdfunding from my perspective next class, but, if you're gonna be going knocking door to door asking for people for money for real estate, I think you're gonna be violating.
No,
this.
what I'm saying, I mean, to.
Not violating, you gotta comply with this.
To be more specific, and I'm not talking about any specific plan, but for example, if you have a,
Whoa,
if you have a project, and I come talk to you, and I ask you for money, and then you say, you know what, I only have 50,000, but I have another friend that maybe a little more. Is that,
listen, I'm gonna stop it here because I've got 2 more slides
Okay.
going. You gotta get out of here. But what I would tell you is, it sounds to me like the path you're going
okay,
is much closer to solicitation
okay,
to the general public and likely to be
regulated,
an activity that,
needs to be regulated.
yeah,
Okay.
and that you need to comply, then I'm going to institutional guys. Wait 1 second, because I'm just one slide.
Oh, he's kicking us out.
Sorry? No, he's not kicking you out.
He's doing us something.
Okay, the last thing I want to cover is hedge funds. Hedge funds are
We need a whole class for that, Professor.
no, but I'm just going to do 1 slide because I'm not going to spend a lot of money on hedge funds. Hedge funds,
Hedge funds is
Are-
also mutual funds?
hedge funds are pools of money that are outside the purview of the Investment Company Act of 1940. So they are large pools of money, institutional or wealthy individual, by nature qualified investors.
They're classified as asset management companies, right?
Yeah.
That's what
That's
it
how
says.
it is.
And that's why I have it here.
Outside of what?
Outside the purview of the Investment Company Act of 1940. So again, investors there would auto-exclude themselves. They have to be qualified investors because there is no reporting. There's been a lot of criticism of the hedge fund industry, probably justifiably, because there's lack of transparency. They don't hedge. There will be I don't think I'll spend any more time on hedge funds. What I will say is, what hedge funds do is they provide liquidity in exchange for assumption of risk in a lot of places where people wouldn't otherwise. And in real estate, for example, going back to in the late 80s, late 2000s, mid 2000s, they, for example, provided a tremendous amount of the mezzanine capital that multifamily developers needed in South Florida to build all the towers that they did. In exchange for a higher rate of return, they assume more risk. But they're very opaque. You don't know what's there. They tend to exploit situations using significant sums of leverage. So, like in 1988, we had a huge financial meltdown when a company called Long-Term Capital Management that was levered like 200 to 1. It made huge bets in currency trades, blew up, and had a ripple effect through the financial institutions in this country, and the whole stock market, sort of debacle associated with it. And so Bear Stearns, had a couple of hedge funds that they managed that invested highly levered in residential real estate pools and things like that. And so, and again, people didn't know. The whole issue, what happened in 2008, had to do with a lot of leverage and people not knowing who they were in bed with and what assets were underlying their investment in a financial instrument, whether it was debt or equity. That said, they also provide liquidity, because as much as hedge funds caused the problem, they also provided tremendous liquidity to the stock market where they saw opportunities in 2008, 2009 when they saw such depressed values, okay? And so, there's 2 sides of that equation. Hedge funds don't hedge per se. They tend to use a variety of different strategy. They'll go directional. They'll be like way long or way short, and they'll lever that. They'll exploit specific situations. They'll play arbitrage, like with an acquisition. They'll short the buyer and go long the seller, as an example, you know? Why? Like, for instance, what AT&T offered to buy, Time Warner the other day, right? $104 a share. Where's Time Warner trading? 80 something. So why? Because the market thinks the deal doesn't get done. Well, if you're a hedge fund, the strategy you might take is, you know what? I'm gonna go big on this one, because I bet it's going. And I'm gonna employ a lot of leverage on it. So I'm gonna, you know, trade on margin with that and like lever up highly. And they might have a big payday,
So,
Well, how do you
or not.
How, okay, but put some numbers on it. So if it's going at 80 and it's gonna trade at 104 or anything.
So you could buy one share, right? You could buy one share, and if the deal closes, you made $24. That's, you know what, almost a, you know, 30% return on your money in what, maybe a year.
Oh, okay.
And then you could borrow the money. So I put 10 cents equity and borrowed 90 cents on the dollar at a 2% cost.
so basically they use
Okay.
high risk method they use high risk method, right? That's what they use?
Well, there's a higher return expectation from the investors, and so they assume higher risk. Now,
Who do they borrow from to?
financial institutions, banks.
Banks?
Why do you think the Federal Reserve and the US government acted in 2008? Because all the banks were gonna go under in this country. What did I say earlier? Who finances all these shadow financial institutions that provide mortgages in this country today? Banks. Why did I express that concern when the class started? Because the banks aren't loaning directly, but they're loaning to the people who are loaning who aren't regulated.
More back.
And ultimately,
Passing on the risk
if there is a
of-
systemic problem,
We face that.
so with that, I hope you've enjoyed today's session.
Yes.
Well, that last hour and a half was excellent.
What about the
Well, the one before stunk,
What?
the one before stunk.
Well, yeah.
I look forward to seeing. Hedge fund.
So what is this class, Professor 4G? How to build Legos?
All the insiders.
It's the land use planning class.
One of his coworkers traded on that.
Dr. Forey, do we still get the REE reports?
Can't.
Limited ones
You're
that I
not
think,
gonna have to be happy with
Trowan
what
sent
you're
you.
making.
It's Sherwin?
Or